Short squeezes can be the biggest moves of the year, even of the decade, but only if you know how to play them safely. There's a lot of rules, there's a lot of things you got to look for, and it's especially important with these types of stocks when they're squeezing. Now the key is don't be the last one in, okay? Last thing you want to be doing is buying the top of a stock up 400% on the day. I mean, there's a lot of downside there. So let's trade them smart. Now, what is a short squeeze and why it happens, okay? Basically, when you think of what creates a short squeeze, and I'll talk a little bit about short selling just to kind of introduce those that are new. When you short a stock, you actually borrow shares from your broker. This can get a little complicated, so stick with me. You have to borrow shares from your broker. Basically, your broker obtains those shares from long-term shareholders, people that have no intention of selling anytime soon. They obtain those shares, they pay a little bit of fees and interest to the long-term holder. So, and if you're not planning on selling anytime soon, there's no real downside, because you're just making a little bit of fees on the side, a little bit of interest basically. But you borrow those shares and then you sell them first, okay? When you short a stock, you sell first. So you actually take a negative position in the stock, and then things go your way. Like say you short a stock at $2 and it drops to $1, you collect the premium. So let's say you have 1,000 shares. In that scenario, you would buy to cover, which takes you back to a neutral position, 0 shares. Those shares are returned to the broker, and you would collect in that scenario $1,000. 1,000 shares times $1 a share. Now, what creates a short squeeze is, if you think about when you go long a stock, which is what most of you guys are doing, you're buying the stock. So let's say you buy that $2 stock again. Instead of shorting, you're buying, you're going long, and it's 1,000 shares again, so it's a $2,000 position. The worst possible thing that could happen, the worst, is that stock goes to 0. Now that's the absolute worst thing to happen. Stocks do go to 0. It's rare, but it happens. And in that scenario, you would lose your entire $2,000. Now, hopefully you have a stop loss and you're out way before it goes to 0, but it happens. People do it. They become bag holders. So your max exposure, the most you can possibly lose is $2,000 because stocks can't go below 0. They can't. Now, vice versa, if you short that stock, 1,000 shares at $2, it could go to $4 a share. We see that every day. You're down $2,000. Now, it could also go to $6 a share, or $10 a share, or $100 a share. Or, I mean, there's no cap on how high a stock can go. Some of you might be familiar with Berkshire Hathaway. It's like hundreds of thousands of dollars a share, and it could still go higher. There's no upper limit. So in that scenario, when you short a stock, in theory, now it's not like a stock's going to go to 1 million, but in theory, your losses are potentially unlimited. So because of that, we can identify key levels on the chart that we know shorts are going to panic cover. Now, remember what I said a minute ago. When you buy to cover, you close a short position, you're buying. Okay, you have to buy that stock to get back to neutral and to control your risk and not risk your blowing up your entire account. So when we look for these short squeezes, we actually capitalize on key levels like red to greens, high a day. We love that high a day because we know a lot of short sellers put their stops there because they know a lot of these stocks, when they break out to the high of the day, they tend to have that second leg higher. Now, the other things we look for, very low float stocks. Lower the float, the better. Now, the reason that's key is if it's a really low float stock, there just aren't going to be that many shares to borrow. So what's going to happen is when it gaps up early in the day, shorts are going to rush in because they don't want to wait until all the shares are gone, because that happens very common. There's only so many shares to borrow to short. So they tend to rush in early and use that high a day as their stop, or red to green, or a lot of different other levels we'll talk about. But if it's a low float stock, you can almost guarantee it's heavily shorted, especially if it has unusual volume. Now, if you watch a lot of the videos, we look at the 60-day average volume to consider unusual volume. You'll see a lot of these low float stocks that were trading thousands of shares a day, like the entire day. All of a sudden they get a press release and they'll be trading 20, 30, 40. I've seen 100 million plus in pre. Think about that relative to the float and relative to the average volume. So now you know that not only is there very few shares left for the shorts to even buy, but the locates are probably already gobbled up early. So when you're looking for epic squeezes, you want those beat down stocks, lower the better, low float, extremely unusual volume, and a catalyst. Now, how we spot them and how we trade them is we're looking for these stocks that when they pull back, they kind of just pull back a little bit. You know, they don't crater. Now, if they crater, the shorts are going to cover for profits and be out, so there's no likelihood of the squeeze happening anymore. But when they spike and pull back a little and then start to hold, that's when you know shorts are nervous. They got their finger on that buy button, getting ready to cover, and we can capitalize on those levels by being ready and anticipating. Now, what I like to do for entries and exits is use stop limit orders. Now, some of you might say with a stop limit order, sometimes you miss fills. You can miss a fill occasionally, but man, if you can have that stop limit order waiting at that key level and it hits, and then you get that avalanche of both longs buying because they recognize the squeeze and shorts covering, there's just almost no sellers at that point, which creates that rapid skipping price action to the upside. Like if you ever wondered why some of these stocks will spike, pull back a little, not much, but hang near the highs, then when they hit that high a day, it's just like the biggest green candle you've ever seen. It's because there's an extreme offset of buyers to sellers. You've got like, I mean, I'm going to make up a ratio here for illustration's sakes, but you're talking like 90% buyers and 10% sellers. So when you think about any market, what happens when 90% are buying and only 10% are selling? That price is going to skip to the upside really fast. And as more people see these hit their scans and recognize that, more people pile in, which creates more buying, more market orders, more short seller panic. So it's one of the absolute best strategies out there to day trade, especially if you're really busy. Now, do we get an epic short squeeze every day? No, that's the one downside. But it happens at least once a week, sometimes 2 or 3 times a week. So if you watch this video and you take notes and you know what to look for, you can day trade, especially if you're really busy. Just wait for the squeeze. Be patient. Let it set up and capitalize when they break those levels. And listen, there's a lot of other things you can do. You can look at the cost to locate these stocks. Now, sometimes you have to open up multiple brokerage accounts. I like to use a lot of crowdsourcing tools. Like I'll ask a lot of people in my mentorship group that have brokerage accounts all over the place, like how much are the locates? So if you start seeing the cost to locate a stock rapidly go up, that's based on supply and demand as well. So when you see that, you know people are gobbling up the shares, and you're probably going to get a quick spike to the upside when it hits that high day. So like I said, there's a lot of complications with short selling. It's really difficult for newbies. I don't really consider it an advanced strategy, but it's more of an intermediate strategy. But what I would rather see you guys do, instead of dealing with locate costs and borrows and unlimited potential losses, is trade the squeeze. You know, these happen again 1 to 3 times a week. And if that's all you trade, like sometimes people come to me and they're like, Tim, I want a day trade. I don't have much time. My first answer is always squeezes, because the risk to reward is amazing. When you win huge. When you lose small. And it's very friendly when you simply don't have much time to trade, you know, just sit there at the computer 12 hours a day like I do. Now, this is a brief video, kind of ran you through kind of the 10,000 foot view of trading short squeezes. If you're curious and you want to know more, I was actually a short seller for over the first decade of my career. First decade up until 2016, I was 90% a short seller, but it was a different market. That was back in a different time. Since 2016, the market has completely rotated. It used to be a short seller friendly market. Now it's a long bias friendly market. So I know all about all the intricacies and all the things that go into shorting. And I think that's one of the things that makes me so good at spotting these short squeezes. So if you want to know more, if you're curious about this, if it sounds attractive to you, check out Short Squeeze Pro. It's actually an entire program where I go in depth. There's hours and hours of courses, chart examples, everything, way more than I could give you in a 10-minute YouTube video. So hit that link if you want to know more about the squeeze. And even if you don't hit the link, let me know in the chat how much you love squeezes.